Welcome to the Roundup covering what's important to accountants and advisors across the month of June. We'll look at the consultation that's been released on the non-arm's length expense rules. We'll also have a look at the raft of final determinations and rulings from the ATO. But first up, the skills and technology boosts have passed through Parliament. Now, there's been a huge amount of interest in these and how clients can maximise an advantage from these. Michael, what do we need to know?
Yeah, those skills boosts and technology boosts have finally passed through Parliament. And probably the reason why we've been hearing a little bit more about the technology boost, so far anyway, is because the deadline basically to qualify for bonus deductions under the technology boost was 30 June 2023. And so by the time you see this, that deadline is probably already passed. In some ways, that's going to be a little bit frustrating because these measures were initially announced back in the federal budget that was March 2022. We then had an election, we had a change of government, there was a period of uncertainty in terms of whether the new government would actually continue on with these measures. And finally, they confirmed that they would. And we had a consultation period, we then had a bill introduced to Parliament back in November 2022. And it looked like we would finally have some certainty and clients would be able to commit with confidence to expenditure on technology upgrades, but also around the skills boost as well. The problem is it has taken until mid to late June for that legislation to finally pass through Parliament and finally be enacted so that we do have that certainty. So really what we had was about a week or so from the time the legislation was passed until the end of the technology boost qualification period, which, look, is a pretty frustrating situation to be dealing with. So I think what a lot of us are going to find is we're going to be asked questions and we're going to hopefully be prompting clients as well to unearth expenditure that those clients have already incurred, basically from when the budget announcement was made, so 29 March 2022, up until the end of 30 June 2023, because that is the time period for which we need to be looking at for the technology boost. So what we're looking at is, has the client incurred any expenditure on digitising their operations or in terms of improving or upgrading their digital capability in connection with their business activities? And that's the type of expenditure that might qualify for the technology boost. Now, the way it works is the technology boost is effectively a bonus deduction. So you spend $100 on digital operations, you claim a deduction, hopefully for that $100, but you also get a bonus $20 deduction. Now that bonus deduction is only available for business entities that satisfy a $50 million turnover threshold. So aggregated annual turnover of less than $50 million, and you will need to apply grouping rules to come up with that, determining whether that threshold is satisfied or not. So $50 million is the threshold for this measure. The thing to remember with the technology boost is that it is capped. So there's a $100,000 expenditure cap per year. So for most people with a 30 June year end, that would be some of the 2022 year. So a maximum bonus deduction of $20,000 in the 22 year and a maximum bonus deduction of $20,000 in the 23 year as well, because we're looking at 20% of qualifying expenditure, but subject to a $100,000 expenditure cap. So they're probably the key things to remember for the technology boost. Now, we have already received lots of questions in terms of what can and can't qualify for that particular boost. While the EM to the legislation gives some examples of the types of things that qualify, they're certainly not meant to be exhaustive, and there is an acknowledgement that there is potentially a wide range of things that could qualify. Really, we're asking that question, does this expenditure relate to the entity's digital operations or digitising their business or business operations? And really, that's the key thing that we're focusing on. Now, there are some things that are specifically carved out. One of those is costs related to training or education. So there's a specific exclusion from the technology boost for those costs. Now, where that's the case, where clients have spent money on education, training around, say, new technology within the business, you would consider whether that qualifies for the skills boost, but unfortunately it won't always, because there are some strict parameters around the skills boost.
What are the key things then that we need to be aware of with the skills boost?
Yeah, so the skills boost in some ways looks pretty similar to the technology boost in that it provides bonus deductions, and the bonus deduction is based on a 20% rate as well. So again, you spend $100 of qualifying expenditure on training up staff, and you get a bonus deduction of $20 on top of the deduction for the actual cost itself. But there are some differences when it comes to the skills boost compared with the technology boost. The first one is the period of time during which you're able to incur expenditure and still qualify for the boost. The technology boost, basically the qualification period ended on 30 June 2023. The skills boost runs for another year. So you can incur expenditure up until 30 June 2024 for a kind of a standard 30 June balancing entity, and that expenditure can still qualify for the skills boost. So we can be a little bit more proactive, I guess, because we now do have legislation, it's in place, we have some certainty and confidence in terms of what the rules actually are. So we can be a little bit more proactive in terms of advice that we give to our clients so that they can take advantage of the skills boost, because we've got another year basically for that measure still to run. The other key difference is that the skills boost is not subject to an annual expenditure cap. So 20% bonus deduction, but not limited in terms of cost. So you can spend any amount on training staff and you'll get that bonus deduction of 20% as long as it falls within the parameters of the boost itself. Now, in order to qualify for the boost, really the training needs to be related to training or development of basically the employees or the business. And again, we need to make sure that we're looking at businesses that have that aggregated turnover of less than $50 million. But the key thing we need to remember here is that the skills boost is reasonably limited in terms of who is able to provide the training. Now, the training needs to be provided by an external party, so it's not going to be internal training that qualifies, but that external provider needs to be registered with certain government departments effectively. So for example, registered training organisations, those sorts of organisations. So the fact that you are genuinely engaging a third party who's unrelated to help train or upskill your staff, that won't necessarily mean that the expenditure qualifies. You need to make sure that that training provider is registered in the right way and that the training they're providing relates to the registration that they have. So that does put a limit in terms of what sort of training will qualify for the boost. But really the good news is that this legislation has finally passed. It's taken a long time and it's really unfortunate that we have had that time period, particularly for the technology boost, pretty much run out before we even had legislation in place. But we can still then now kind of work backwards, identify clients who've spent money on technology, on skills and training as well, make sure that those are picked up as part of the 2023 tax return process, and then moving forward into the 2024 year, again, giving clients proactive advice in terms of what might or might not qualify for the skills boost and making sure that gets picked up as part of 2024 tax return work.
For superannuation funds, there's been uncertainty for quite some time on the treatment of non-arm's length expenses. Now, Treasury's released the new consultation. Jason, where are we up to with all of this?
So this has been quite a journey. So the law first changed back in 2018. So we've always had non-arm's length income provisions where funds can be taxed at a higher rate of 45% if they incur income that is of a non-arm's length nature. So that was extended to cover non-arm's length expenses back in 2018. So essentially what this means is if an SMSF incurs an expense, usually with a related party at below market value, then that can cause all the income of the SMSF to be taxed at 45%. We also had a PCG come out not long after that to say that due to the uncertain nature of this and the fact that there was some consultation, the ATO wouldn't apply compliance resources on this until 1st of July 2023. Subsequent to that, we also had an LCR come out in 2021 which clarified some examples of what might be a non-arm's length expense. So that LCR included examples of tradespeople, perhaps undercharging or not charging their fund for substantial work. It also included examples around accountants using their employer's software or getting discounts on preparing the SMSF returns. So that LCR is still what we would look to see whether a particular event might be considered non-arm's length. Where we go to now is how would that be taxed? So as the law was rewritten in 2018, a non-arm's length expense that was of a general nature, so something like an accountancy fee or an admin fee, that could cause the entire income of the fund to be taxed at 45%. So there was a lot of pushback on the severe punishment that could bring to an SMSF. So where we are at the moment, so announced in the budget is that the government would look to only apply that extra 45% tax on 2 times the non-arm's length expense breach. So if someone had undercharged their fund $5,000, then 2 times that is $10,000, and the 45% would apply to that $10,000, and the rest of the fund's income would be taxed as normal. So we're really just waiting for that legislation to be introduced and passed. So recently we had a consultation paper. So we've had a lot of consultation already. We seem to have an exposure draft which is looking to apply that 2 times measure. So that's open until the 7th of July. And then we're hopeful that soon after that, we'll have some final legislation. So we will have some clarity going forward now that PCG guidance is removed.
Who is this going to predominantly impact?
So potentially this could impact any member of an SMSF, but we're finding with our help desk that a lot of questions are coming in on accounting fees. So a lot of the questions are probably coming from a member or employee perspective. So I think what's important to note is, so the LCR 2021/2, that does indicate that we do need to be charging market rate fees on accounting services. So that's a given. So as a starting point, we need to look at providing those market rate fees to related SMSF. So whether that be staff members or family members. The LCR also goes on to say that it is possible to apply a discount policy. So perhaps your firm has a discount policy where every employee, director, shareholder, or whoever it may be, gets a certain percentage discount. So that needs to apply across the board. That needs to be documented. And if it is, then a discount policy can apply. But we certainly can't have one-off discounts for directors or one-off discounts for certain staff members. It does need to apply across the board, or otherwise they pay full market rates. It can also apply to tradespeople as well. So there's some examples in the LCR on a plumber, some minor examples where perhaps they change a washer on a tap or things like that. They wouldn't be generally expected to be remunerated for that. But if they're over putting in new hot water systems or doing major plumbing work, then they should be remunerated at market rates for that type of work. So that's what we're seeing at the moment. Tradespeople and then people associated with the SMSF administration, so whether that be accountants, lawyers or auditors, all need to be remunerated at arm's length or be subject to a across their firm discount policy.
Is there any flow-on impacts from this to other parts of superannuation?
So as well as covering general expenses of the fund, the LCR also talks about contribution situations. So there are some good examples in there. So perhaps a member decides that they want to transfer their $500,000 property to their super fund, but their super fund only has $300,000 in cash to pay for that property. That can be okay as long as that is recorded as a $300,000 purchase and a $200,000 contribution. So there's one example in the LCR where that's done correctly and all documented at the time as a $500,000 transaction made up of a $300,000 purchase and a $200,000 contribution. There's another example in the LCR where the contribution part isn't dealt with at the time, and that indicates that transaction would be treated as being on non-arm's length. So this is a little bit contradictory to what's currently written in our contribution ruling, TR 2010/1. So in that ruling, which was written some years ago, that ruling covers the fact that if an asset is sold to an SMSF for below market value, the difference will be a contribution. So we have a draft version. It's been in draft for a while. We have a draft version of that being updated just to align with the LCR, so that it is important that if we are selling an asset to a fund at lower than market value and making up that difference as a contribution, that contribution needs to be documented at that time as part of that overall purchase contract. It can't just be an afterthought. If the fund only purchases that asset for $300,000 and there's no documentation, then we're looking at a $200,000 non-arm's length transaction. So there are some flow-on effects, particularly in the contribution space as well, to be mindful of, and we'll keep you updated as soon as that draft ruling is finalised at some point.
Now, there's been a bit of an onslaught of final rulings and determinations from the ATO. Matthew, what do we really, out of all these, what do we really need to be paying attention to?
Yep. Look, the ATO have been quite busy leading up to the year end, and they've made a fairly decent push around finalising some of the rulings and determinations that have been issued previously in draft form. I think one of the issues that's a bit of a sleeper, and one that we probably should be paying a bit more attention to, is labour costs. So things like salaries, wages incurred on the construction of capital assets. Now, the ATO's finalised their ruling in this area in the form of TR 2003/2. Look, it's been a while. It's been 3 years, I think, in draft form. And before that, that ruling originated from an ATO ID. Now, when a client carries on a business and they pay salary, wages to their staff, we'll often claim a deduction for those wages under the general deduction provisions in Section 8.1. Look, that's on the basis that those salaries, they've been incurred in the course of generating assessable income for the client, and it's just a revenue expense. It's recurrent, it's ongoing. We normally just see that as a ordinary, normal business expense. Now, whilst the ATO is saying that's still true, in most cases, it's saying that it's not always going to be the case. We do actually need to look at what the employee is actually doing. If the employee's been engaged to specifically construct a capital asset, or even oversee or organise their construction, then those salary and wages are probably capital in nature. If the salary and wages are capital in nature, what that means is that we won't be able to claim an immediate deduction under Section 8.1, but then we'll often look to see if we can get some relief in the form of depreciation deductions or capital works. The more tricky aspect, though, is when we have employees that might be engaged to do a mix of duties, or where we might have an employee that's changed their duties or changed their role partway through the year. In those cases, the ATO does say that we do need to make a reasonable apportionment based on budgets, timesheets, and the like. So, for example, if an employee has been engaged specifically to construct a capital asset, a building, that building's finished, but that employee's been retained in the business to help with the ongoing maintenance and upkeep with that building, well, that role's changed. And, we do need to make an apportionment in that case. The good news, though, is that the ATO still retains its view that where an employee's role is quite remote or even incidental to the construction of capital assets, well, the ATO is saying that's fine, and we don't normally need to make an apportionment in that instance. And the ATO does have an example that it's retained in its final ruling of a general manager that's whose main responsibility is the overall day-to-day operations of that business. But at least for part of the week, they might be engaged to have discussions around a capital project or write reports around a capital project. And the ATO is saying, look, that's fine there, and there's no need to apportion. Now, the last thing I did want to mention is that this ruling is not just targeted at labour costs incurred on constructing capital tangible assets, so things like buildings. It can equally apply to intangible assets. So think, for example, software, patents, that could be potentially covered as well. Now, by and large, the final ruling is quite consistent with the draft. But I think the real key message here is that it's very easy to assume that salary, wages, that they're going to be a revenue expense. And what the ATO is telling us is that that's not always going to be the case. And we do need to check.
Apart from that ruling, is there anything else that's been released or updated by the ATO over the last month that we should really be aware of?
Certainly. The ATO have finalised 2 rulings, determinations that I think could be of interest to certain clients. Because we've covered them in a recent monthly update, I'm going to try and be quite targeted in my comments. The first of these rulings deals with individual residency, or the ATO's view on individual residency. And that ruling's been finalised in the form of TR 2023/1. Very important just to keep in mind that the residency rules, those 4 residency tests, haven't changed. They remain the same. Previously, the ATO's view on individual residency was contained in 2 separate rulings. But what the ATO has done now is they've consolidated those principles into a single ruling, which is now finalised. And in that process, they've updated their guidance to make sure that it's more in line with a fairly large number of court cases that have happened since then. Now, by and large, the final ruling is quite consistent with the draft. I think one of the key messages in the ruling is that you do really want to be careful around trying to take the position that someone's broken residency where they're working overseas for a couple of years, but still maintain or retain significant ties to Australia. So where they might have assets here, family in Australia, or when they're coming back to Australia quite regularly. Those cases tend to be the more difficult residency cases, and at least in the more recent years, a good number of those types of cases have ended up in the courts being contested. So just want to be a bit more careful around those situations. Moving on, the second determination that I want to talk about is the ATO's determination on income from the use of someone's fame. So like a sports person's fame. The issue that the finalised determination is trying to get at or really trying to ask is whether income from someone's fame, an individual's fame, can be diverted and taxed in a related entity, like a trust. And the ATO's view there, at least now, is no. And the way the ATO gets there is by saying that an individual can't legally own property in their fame. So they can't legally transfer property in that fame to a related party. And even licensing it to a related party won't be effective either. So what that basically means is that where income is being derived from the use of someone's fame, it should basically just be taxed in that individual's hands. Now, the determination is not trying to target income from the use of assets that someone can own, intangible assets that someone can own. So think things like copyrights or trademarks that can be transferred and can be licensed. In those cases, it can be possible from income from the use of those assets to be taxed in a separate entity. Now, if you have clients that are thinking of entering into arrangements or have entered into arrangements around licensing their own fame, very important to visit this area and visit the guidance now that it's been finalised. If you have clients that have previously entered into these arrangements, you might be aware that the ATO previously had some guidelines that accepted these arrangements up to a 10% safe harbour. The ATO is now saying that if taxpayers have entered into these arrangements, they won't dedicate compliance resources to looking at these arrangements, at least up to 30 June 2023, if the taxpayers' arrangements are consistent with the principles in the guidelines and taxpayers entered into these arrangements in good faith.
And that's the roundup for this month. If your firm is a member of Knowledge Shop, we'll be posting the New Year standards, the year-end compliance standards for individuals, superannuation funds, trusts, partnerships, companies. They'll be on the knowledge base in the first week of July. If your firm is not a member of Knowledge Shop as yet and you'd love to see how we make the lives of professionals in practice just that bit easier, give the team a call or visit the website knowledgeshop.com.au and book in a time to have a look. We'll look forward to speaking to you very soon.